Hello, everyone. Welcome back to Boss Economic World. I'm your host, here to strip away the jargon, laugh at the absurdity of the markets, and restore the full, unvarnished picture of what is actually happening to your money. Today is Monday, December 8, 2025. If you are watching this while sipping champagne, celebrating the guaranteed interest rate cuts you thought were coming for Christmas, put the glass down. Seriously, put it down. Because the European Central Bank just decided to play the role of the Grinch. For the last year, the narrative has been as sweet and sticky as molasses: inflation is dead, growth is slow, rates must fall. That was the lullaby the market sang to itself to sleep at night. But over the weekend, Isabel Schnabel, the executive board member of the ECB and the woman I affectionately call the Iron Hawk of Frankfurt, walked into that sleeping nursery and smashed a cymbal. She didn't just hint that rate cuts are over. She signaled that the next move might actually be a hike. Yes, you heard me. A rate hike. In Europe. In 2026. Today, we are going to break down exactly what Schnabel said, why the euro is suddenly skyrocketing to $1.16, why the US and Europe are drifting into two different economic universes, and what this Trump tariff aftermath really looks like. We are going deep, friends. Let's get to the truth. Let's look at the data on the table. As of this morning, the ECB's deposit rate is sitting at 2%. Most analysts, those folks in expensive suits who love drawing straight lines on charts, were predicting we'd stay here for a bit and then gently glide down to 1.5% or lower next year. Isabel Schnabel just looked at those forecasts and laughed. In an interview released last week from her office in Frankfurt, Schnabel said something that made bond traders choke on their bratwurst. She said she is comfortable with investor bets that the ECB's next move is an increase. Now, let's translate central bank speak into human speak. When a central banker says they are monitoring the situation, it means they are panicked but don't want you to know. When they say rates are in a good place, it means they are too lazy to move them. But when Isabel Schnabel says she is comfortable with hike expectations, she is effectively screaming, the economy is too hot and money is too cheap. She explicitly stated, both markets and survey participants expect that the next rate move is going to be a hike, albeit not anytime soon. I'm rather comfortable with those expectations. This is a massive deviation from President Christine Lagarde's recent wait-and-see approach. Schnabel is the first policymaker to declare that we haven't just paused cutting, we have hit the floor. The basement door is locked. The elevator is only going up from here. Why does this matter? Because for the last decade, Europe has been the sick man of growth. Now, Schnabel is telling us that the sick man just ran a marathon and is asking for a protein shake. Now, you might be asking, boss, how is this possible? Donald Trump is in the White House. He unleashed tariff turmoil on the world. Shouldn't Europe be collapsing under trade wars? This is where the mainstream media failed you, but where we succeed. We assumed that the tariff wars of 2025 would crush European exports. We were wrong. And Schnabel explains why in a fascinating way. She notes that uncertainty has dropped faster than expected. You see, businesses hate not knowing. Once Trump slapped the tariffs on the table, the uncertainty vanished. The rules were set. And what did European companies do? Did they cry? No. They adapted. Schnabel points out that the impact of tariffs has been milder than expected because of a massive reorganization of supply chains, essentially trade rerouting. Europe shifted focus. They aren't just selling to the US, they are selling to the intermediaries, and they are doubling down on internal demand. But here is the real kicker, the secret sauce of 2025, the war economy and the AI boom. Schnabel highlighted that growth is being bolstered by a jump in government outlays on defense and infrastructure. We are living in a geopolitical powder keg. European governments are finally spending the 2% to 3% of GDP on defense that they promised for years. That is billions of euros flowing into factories, steel, tech, and logistics. That is pure stimulus. Simultaneously, we are seeing a rally to adopt AI technology. In 2023 and 2024, AI was a stock market bubble. In 2025, it became a capex reality. Companies are buying hardware, upgrading data centers, and automating workflows to offset their aging workforce. So, you have government spending plus business investment plus resilient consumers. Result? The economy isn't slowing down. It's heating up. Let's look at the immediate market reaction, because money talks louder than words. Following Schnabel's comments, the euro climbed 0.3% to $1.1672. Why? Because capital flows to where it is treated best. If the ECB is going to pay you higher interest rates than the Fed or the Bank of England relative to inflation, you buy euros. Meanwhile, German 10-year yields jumped to 2.83%, the highest since March. If you are holding long-term bonds, your portfolio just took a hit. Yields up means prices down. The bond market is waking up to the realization that the era of low for long is dead. Schnabel mentioned that the third quarter data was already better than expected. The ECB's previous forecast said growth would slow to 1% in 2026. Schnabel is now signaling that at the December meeting, those projections are going to be revised higher. And here is the most dangerous chart in economics right now: unemployment. Unemployment in the Eurozone is near a record low. Wages are rising rapidly. People have jobs. When people have jobs and get raises, they spend money. When they spend money, prices go up. This is the wage price spiral that keeps central bankers awake at night. Schnabel said, services prices remain the most important challenge due in no small part to wage rises. Translating this, your haircut, your restaurant meal, your insurance, and your legal fees are going to keep getting more expensive. And because services make up the bulk of the modern economy, inflation isn't going back to 2% quietly. It's fighting back. This is the part of the show where we look across the Atlantic. Usually, the global economy is a synchronized dance. The US Federal Reserve leads, and the ECB follows like a slightly awkward younger sibling. Not this time. Schnabel's stance highlights a massive divergence. The US and the UK are, according to the latest reports, still in cutting mode. Why? Because they are grappling with stickier inflation but a softer consumer. It sounds contradictory, right? How can you cut rates if inflation is sticky? Because the US consumer is finally tapping out. The credit card debt wall has been hit. The Fed is trying to engineer a soft landing by cutting rates to keep the liquidity flowing, even though inflation is hovering above target. They are prioritizing growth over price stability because they are terrified of a recession. Europe, on the other hand, is in a Goldilocks zone, but a weird one. USA, slowing growth, sticky inflation. Fed cuts. Europe, accelerating growth, sticky inflation. ECB holds or hikes. This is why the euro is crushing the dollar right now. Schnabel noted that the US Federal Reserve halted its balance sheet rundown this month. They stopped sucking money out of the system. The ECB? They are still letting bonds roll off. They are still tightening liquidity. Schnabel said, the process of allowing maturing bonds to roll off is progressing smoothly, excess liquidity remains abundant. She even threw a little shade at the analysts predicting the ECB would follow the Fed next year, saying, that broadly corresponds to one end of our range. The other end of the range is much later. Translation: don't hold your breath waiting for us to copy the Americans. Now, let's get into the nerdy stuff that actually determines your financial future. We need to talk about fiscal policy versus monetary policy. Schnabel highlighted a toxic cocktail. 1. Economy is recovering. 2. Output gap is closing. 3. Fiscal policy is expanding. She said, this implies that the decline in core inflation has stalled, all of which would tend to be inflationary. This has to be monitored very carefully. This is basic economics, folks. If the government pumps money into the economy at the same time the private sector is booming, you get inflation. The central bank's only tool to fight this is to raise interest rates. Basically, European politicians are pressing the gas pedal, and Schnabel is realizing she might need to slam on the brakes even harder. This creates a conflict. Higher rates make government debt more expensive to service. But Schnabel is a German hawk. She does not care about the government's debt service costs, she cares about the stability of the euro. She even dismissed the fears about the EU's carbon pricing system delaying inflation targets in 2027. She said, it's important not to pin things down to any particular number. What really matters is the overall macroeconomic narrative. This is a philosophical shift. She is saying, we don't care if inflation hits 2.1% or 1.9% exactly. We care if the narrative is that prices are out of control. Right now, the narrative is that the economy is too strong for 2% rates. I want to circle back to her comments on AI, because this is the first time we've seen a central banker this senior explicitly link AI adoption to monetary policy hawkishness. Schnabel warned that they must watch if shifts in the economy's potential and the impact of AI render monetary settings that would otherwise be appropriate too loose. What does this mean? If AI makes companies hyperproductive, the economy can grow faster without overheating. That's the optimistic view. However, if AI triggers an investment boom, it creates immediate demand for electricity, chips, construction, and skilled labor. That is inflationary now, even if it is deflationary later. Schnabel is looking at the now. She sees billions of euros being poured into tech infrastructure. That money is chasing goods and services. If the ECB keeps rates at 2% while trillions are being spent on the AI revolution, they are pouring gasoline on a fire. She is telling us, if AI is the real deal, we might need higher rates to keep the investment boom from turning into a bubble. Okay, boss, enough theory. What do I do with my money? 1. If you are a borrower, if you have a variable rate mortgage in Europe or a business loan floating on Euribor, you need to hedge. Now. The market was pricing in cuts. Those cuts are likely gone. If the next move is a hike to 2.25% or 2.5%, your payments are going up, not down. Lock in fixed rates if you can still find them before the bank algorithms catch up to Schnabel's interview. 2. If you are a currency trader, the long euro/short dollar trade has legs. The interest rate differential is moving in Europe's favor. The US is softening, Europe is hardening. Unless Trump pulls a rabbit out of his hat with a massive US stimulus package that reignites US inflation, the euro looks strong. 3. If you are a stock market investor, this is tricky. Usually, higher rates are bad for tech stocks. However, Schnabel is saying rates might go up because growth is so strong. This favors cyclical stocks, industrials, defense, banks. Banks, in particular, love this environment. They earn more on loans while the economy is strong enough that people don't default. Look at European financials. For the no landing scenario, we spent 2024 debating hard landing versus soft landing. Schnabel just introduced the no landing scenario. The plane isn't landing. It's refueling in mid-air and keeping the throttle open. This means inflation stays sticky, growth stays solid, and rates stay high. In this world, cash is king, and real assets are your hedge against the devaluation of purchasing power. So, here is the full picture, restored and concise. The European economy has proven to be incredibly resilient against the geopolitical shocks of the Trump era. The fear of tariffs was worse than the reality. The war economy spending on defense and the future economy spending on AI have combined to create a solid floor under growth. Because of this, the ECB is realizing that 2% interest rates might actually be stimulative, not restrictive. Isabel Schnabel, the voice of reason, has signaled that the party of easy money is officially over. They are not thinking about cuts. They are thinking about whether they need to tighten the screws to prevent the economy from overheating. The US is fading, Europe is accelerating. It is a reversal of the last decade's trend. My advice? Stop betting on the pivot. The pivot is a myth. The reality is a new era of higher costs, higher wages, and higher growth. Adjust your portfolio accordingly. This has been Boss Economic World. If you like this analysis, smash the like button so the algorithm knows you prefer truth over comfortable lies. I'll see you next time, probably when the Fed panics. Stay sharp, friends.